Everyone. Hello, everyone. Welcome. Thank you so much for making time to join us. This is really exciting to have all of you here. There's still people trickling in, but thank you so much for making time. So my name is Frank Aswani. I'm the CEO at AVPA. This is a really exciting day for us. I'm quite pleased to be hosting this webinar today and welcome all of you. As you come in, can you please just let us know your name, your organization, and the city you're dialing in from? So your name, your organization, and the city you're dialing in from. We'll let that run for a bit. It's always good to know who's in the room. So just go into the chat and let us know your name, your organization, the city you're dialing in from. And just to let everyone know that this session is being recorded, so please be aware of that. So you give us your name, your organization, and where you're dialing in from. Just put that in the chat so we can know who's in the room. But thank you so much for all of you making time to join us. Namibia, Adrian, nice to see you. Thank you so much for making time. Black Umbrellas, Mark, great to see you. Samir Adnani from Tunisia, fantastic. Really nice to see you. Michelle, it's been a while. Nice to see you. David from Kiva, thank you so much for making time. Colin from Linear Capital, I hope Julia is joining us as well. Thank you. Judith, I do always in attendance in a lot of our sessions. Thank you for making time. Really appreciate it. Oh, Hoda Salman from Lebanon. Actually, I don't think we ever had anyone from Lebanon join our sessions. You probably are fast. Thank you. Nera, Ishtolram, great to see you. Thank you so much. Annie Potter, always, thank you. Odd from Wings, great to see you. Vanessa, I can see you representing in Kampala. Kanyisile, nice to see you. Sally, Small Foundation. It's a really cool organization. Thank you for being here. So yes, so I think we've got a really cool group of people who've joined us. Bernadette from Mastercard Foundation, Ghana. Thank you for coming through. Tinacho Chitongo, long time. I hope you're keeping well. Yeah, so this is really great. So thank you so much, everyone, for making it. I think we're going to have a really cool session. Kathy Duff, welcome. Emilio Chanda, nice to see you. Rui Barosh, thank you for, I think I've got your pronunciation right. Rui Barosh, yes, we did indeed, Rui, so it's nice to see you. Justin, Standard Bank, always good to see you on these sessions. So thank you so much, everyone. Namasabi, so thank you so much for coming. So we'll get started in a while. We've got a lot more people I think we're expecting to join us. So what I'll do is start off with a bit of just to give you guys context with what we'll be discussing today. I'm super excited today to be hosting Kusi Hornberger, who's author of Scaling Impact. And Kusi has written this book to try and get us better understand this space and what's happening, especially when it comes to finance and investments for a better world. We'll talk to him in a short while, but before we go into that, I do want to just make some quick announcements to all of you who are on the call today, especially about some upcoming AVPA programs. So as you know, we've always run the Catalytic Investment Training Program, in which we open up about 70 slots for people who want to come and get a solid foundational program on Catalytic. Sorry, I was talking about the African Impact Investing Fellowship Program. My apologies. That program will be running for the 3rd year this year. So those of you who are interested to register for a really great and awesome program on impact investing, please do send an email to Abu. We'll be opening up enrollment fairly soon. The program is most likely going to be kicking off in September as usual, and we'll be running for the 3rd year this year. And that program, please take note, is always oversubscribed. So the sooner you can get your application and interest in, the better. But the first bullet point there speaks about a really exciting program that we're about to embark on Catalytic Investment Training Program. I personally strongly believe that in Africa, we're not, and the world generally in the impact space, we're not exactly short of capital. We're particularly short of risk capital. And that training program will look at how people, especially those sitting on grants and governments, can transition from traditional philanthropy into catalytic investment, and in the process, be able to unlock a lot of private capital for impact. Is arguably one of the most exciting programs we are going to be running anytime soon. So please think about joining that program. The admission costs are very cheap. For African organizations, only $100, or African individuals, and for international organizations, $300. So for the Catalytic Investing Training Program, which we are doing in conjunction with MacArthur Foundation as part of the C3 Consortium, which is the Catalytic Capital Consortium, that's coming up sometime in April, May. So please look out for that program. I'd highly encourage as many of you as possible to join that program. I've spoken about the Impact Investing Fellowship Program. The African Healthcare Funders Program, once again, will kick off again in earnest in Q3 and Q4 this year. We had a phenomenal program last year with the last year's cohort, and probably one of the most exciting programs we've hosted. I'd encourage any of you who are playing in healthcare to please join that program too. And I'll talk a bit about a major step for AVPA with regards to AVPA membership. But in case you have any questions around any of these, please send an email to Abu Kari. Abu's email will go on the chat shortly. But in terms of the upcoming AVPA events, as I mentioned to you, we've got a webinar coming up that's part of the Catalytic Investment series of sensitization webinars. That's on April 11th. Please go to our events page and LinkedIn. You'll be able to register for that webinar. We've had two really exciting webinars to date with over 1,000 people registered for the first two. We expect an equally high turnover for the second one. The set of innovative financing research that is being done for South Africa is going to come out in April. Super excited about what that report is going to tell us and inform. And the view is for us to hopefully repeat that particular research in a couple of other African countries. The biggest event in our calendar this year, and which we're very excited to talk about, is our formal launch. So many people think actually we've launched formally as an organization, but we haven't. We were planning to, and COVID happened, so we pushed it out. So we're officially launching AVPA on the 12th of July in Cape Town. So please join us if you can. And there's details at the bottom there of how you can send your interest, and we'll send you an invitation. And we're doing the launch alongside what will be Africa's inaugural Impact Summit, happening on the 13th and 14th of July. So super excited about being able to align those two events, our launch and the Africa Summit in Cape Town. So 12th to 14th, the place to be will be Cape Town City ICC. And as part of that, our launch activities, we shall be launching an initiative that we are doing with Oxford, looking at private wealth in Africa, and specifically looking at family offices. So that activity will be happening on the 12th and 13th of July. So if any of you on this call are part of family offices or do know family offices, please do connect with us. And once again, use the email address info@avpa.africa, follow us on LinkedIn, or if you just connect with me as Frank Aswani on LinkedIn, I'll be able to share all this information with you. Now, before we go any further, Abu, do you want to just check and see how spread our audience is today?
Absolutely.
You can share your screen now, Abu.
So as always, we're doing the poll on Slido. Go ahead, Frank.
No, go ahead, Abu, sorry.
Yeah, so you can go onto slido.com and enter that code to participate in the poll, or you can scan the QR code on your screen.
So please tell us, which country are you dialing in from? Americans, thank you for waking up early. Singapore, thank you for staying up late. And India as well. Appreciate it. Thank you for making time. This is a really important topic, and I'm really chuffed that you could all make time to be with us today. And if you can't actually put your country in the chat, if for any reason you can't use Slido, yeah, put your country in the chat. Madagascar, fantastic. Great to see. Canada, I hope it's warming up. Great to see Uganda, Belgium, Switzerland, France, UK. Cool, we've got a really good spread of people from across the world. This is super, really, really excellent. Okay, Abu, can we take the second question? Why are you here? Netherlands, thank you. What does interest you so much about this topic? We've had a really good registration interest in this webinar. Catalytic capital, impact finance. Scaling. To learn about impact investing. Okay, sustainable finance, local capital, sustainability, sustainable finance. What the book? Well done. Growth, impact. Thank you, Peter Bonan. More knowledge. Mobilize private capital. Cohesion. Financing social enterprise, acceleration, partnerships, impact models, growth, learning. Impact finance, scaling, sustainable finance are very prominently featured on this. Networking. You're at the right place, Christian. Okay, we'll give the other people another 20 seconds. Impact investing, blended finance for health. Right, okay, I think we've got a drift of kind of why people are here. Big focus on impact finance, scaling sustainable finance. Our guest speaker, I'm sure, has seen your views in what interests you most and what attracted you to this particular webinar. So without further ado, what I'm going to do now is to bring in Kusi, who I actually stalked on LinkedIn the minute I saw the book. And I told him, after I found Kusi, I kind of thought this book looks fascinating. It speaks to a lot of the stuff that we are trying to do at AVPA, the struggles we as a continent are facing. And I thought we've got to bring Kusi to speak to our African audience. And we're really glad he could make time to be here with us. And his book, Scaling Impact, Finance and Investment for a Better World, I've read the sample, sounds really fascinating. I'm picking my hard copy on Saturday. I've ordered it. So I'm super excited about digging into it. So our speaker today, Kusi, who's the author, is a partner Dalberg. He's based out of DC. I won't read his bio because I do want us to spend more time engaging Kusi in conversation. So I'll let you just read briefly what he's about. And he has had quite a bit of experience working in Africa and East Africa more specifically. So Kusi, if you are there, yes, there you go. Thank you. And Kusi, do you mind unmuting yourself? I must admit, Kusi, when I first saw your name, I thought this dude must be African.
Yeah, Ghanaian, right? The family name in Ghana.
Yeah, I'm sure you get that quite a lot. In fact, so I'm going to ask the audience, when you hear of Kusi's name, what African name would you give him? What would it be short of? The name that came to mind for me was Kuseni. So in the audience, does the name Kusi trigger any African name before we bring Kusi to talk? Kwesi, Kusile. Yeah, does anyone else have any other African name? Did you also look at the name and think, Kusi must be African?
And in Swahili, they say kusini, like upepo ya kusini, which is from the wind from the south.
We're in from the south, exactly. Okay. Yeah, so Kusimba, Saline. Yeah, someone here even says, yes, my dad and brother are called Kusi. So Kusi, I think by the end of this webinar, we'll find you a passport and a local place for you to happily live on. Excellent. So thank you so much for making it, Kusi. Really happy to have you here. What inspired you to write this book?
Yeah, well, first, just on the theme about my name, I do feel at home in Africa. So it's a real honor to be invited to be here with you, Frank. And I want to thank you and the ABPA team for the invitation. So what inspired me to write the book? Good question. I would say I've always wanted to write a book. It was sort of an ambition and dream of mine from as a little kid. A child of academics, I saw books on the shelves and said, one day I want to write my own book, and I didn't know what it was going to be about, but I knew one day I wanted to do it. And I came to a realization maybe a year and a half ago or so that based on the work that I've been doing, even though it feels like the impact economy is growing massively and accelerating, equally we're seeing the gaps in terms of financing needs to solve problems globally getting bigger and bigger, right? Particularly exacerbated by COVID, the gap has been sort of increased significantly by a third, 40%, $3 trillion a year to something north of $5 trillion a year in financing gap to solve the SDGs by 2030. And I said, okay, we have to do a lot more. We have to accelerate faster. We have to figure out what's working and make those things that are working scale. And I guess rooted deeply in the book, I'm not a revolutionary in the sense that I'm not trying to overthrow the systems that are out there. I think capitalist systems and tools, capital specifically, is useful, but it's not working the way it should be. And so I take the approach of not exactly reimagining, but reforming capitalism to make it work better. And so I think to make capital work better, we have to sort of scale solutions that are working. So I had this idea of how could we accelerate progress? And then I also realized that I was sitting on a wide body of unpublished work. Through my 20 years, I'd written a lot of blogs, written a lot of pieces for clients and for other avenues that are sort of unofficially published. And I said, wouldn't it be nice to put all of that material into an official publication around a cohesive story? And so COVID gave me the window, to be honest, right? There was a lot of time spent at home, a lot of time thinking about what I wanted to focus on and what's needed to be done. And so I took it as an opportunity. And originally, actually, the idea kerneled as something I was going to do for myself. I was just going to put it all together in a book, so I had all the repository of my knowledge in one place. But then a friend of mine encouraged me to consider looking for a publisher and to share. And I reflected on that, and it's in the introduction of the book. There's a memory I had of when I was in graduate school at the Kennedy School, more than 2 decades ago, unfortunately, of seeing a speaker who mentioned, sort of decades of experience working in international development and saying, based on all my experience, I've learned that it's not really doesn't matter if I get the right answer, the technically correct, or, figure out what works. What really matters is if I'm communicating and getting people to act on that answer. And so I believe that's true. I think it's really important to share knowledge, to disseminate and let others benefit from what you know, and hopefully a book is a pathway to do that. Certainly not everyone will pick up and read the entire book. I understand that, but I think it's also a type of book where you can pick up and read different sections. So I also wrote the book with the specific desire of sharing my knowledge with other people, not keeping it to myself. So that was really the inspiration. And yeah, a year later it came to life. I couldn't be happier. It's really it feels like the fulfillment of a lifelong dream, to be honest.
Excellent.
Excellent. Yeah.
And Kusi, you do mention your experience in Africa. Do you want to speak a bit to your experience in Africa? Just what was your path throughout the continent?
Sure. So my first job out of college, I worked in the Peace Corps in Tanzania. I learned Swahili. That's where I learned about kusini.
Are you fluent in Kiswahili?
Nasema sana, yes.
Yeah.
Kizuri sana.
Good.
Kizuri kabisa. No, so I lived there 2 years as a volunteer in the Rombo district of Kilimanjaro. I taught math and computer science as a secondary school. And it was a very formative experience for me because I had studied development economics in college. And at that point, I thought I was going to be a professor. But I realized I saw what development or what life looks like on the ground for real people, everyday lives. I created a lot of empathy with what does a lived experience look like that's quite different than what you read in a book like mine, right? That really formed the foundation of a desire to work on more practical things to help people work on projects. And in particular, where I grew was a coffee growing region. And so I got to know a lot of smallholder farmers. I got to know their families, their aspirations, the challenges and everything that they faced, and what things the challenge, specifically the challenges around climate, the specific challenges around price shifts, challenges around getting their product to market, figuring out quality, et cetera. And so that all inspired me to sort of say, what can I do? How can the market help these families improve their lives? And my first immediate job after that, I worked for TechnoService. I stayed in Tanzania and I started working on the coffee program, directly building off my experience living in the communities. I spent another year there traveling around East Africa. I covered Kenya, Rwanda, and Tanzania in the coffee program. And it was actually the beginning of the coffee program for them. And I'm happy to say that it was quite successful. We helped create farmer business groups and help them get access to international markets that they never had access to, purchasing coffee directly from these businesses instead of via the government, and increasing incomes, et cetera. So I learned about the power of markets then. I also learned about the power of sort of advisory services and projects. So that was my direct, live on the continent experience. Ever since then, I've always had a love for the continent. When I was in graduate school, I worked on projects in Sierra Leone. Got to travel to Sierra Leone. I did sort of a growth diagnostic assessment on what would be some of the potential levers that the World Bank could, invest in to unlock investment. That led to me working at the World Bank and IFC, where I covered West Africa, I was an investment officer looking for investment opportunities in tourism, manufacturing, agribusiness, and services. Got to travel across West Africa, Nigeria, Cameroon, Ghana, Sierra Leone many times, spending as long as 5 weeks at a time there. So I got to see that vantage point as well. And then ever since then, all of my jobs have touched on Africa. At Dahlberg, Dahlberg really grew up in Africa. It is a global organization, but more than half our staff and more than half, roughly half of our offices are based on the continent. There's a lot of pride about being a truly sort of Africa-led management consulting firm, and we do a lot of work, I think, with many of you or many of the organizations. So I'm still deeply connected. I sit in Washington. Unfortunately, now I'm the classic DC, bandit, and the best I can do is provide knowledge and insight. Spending less time on the ground, but I do appreciate what's going on in the continent. So that's my lived experience. I guess one more thing I should mention is when I was at Global Partnerships, which is an impact investment fund based in Seattle, I actually helped them set up their office in East Africa. So including the first trip to Nairobi to find an office location, we set up with the Grameen Foundation at the time, and built the office from a team of 1 to I think it's now a team of 12 people, from 0 investments now to several dozen, and investing across the region. So lots of touch points and experience, I would say.
Excellent. No, fantastic. So the book is about innovations in the practice of finance that can create sustainable outcomes.
Right.
Do you have a finance expert to read the book?
Yeah, so the way I look at it is I saw sort of 6 broad areas of work that I typically do as in the finance and investment practice at Dahlberg. And in each of those broad areas, I saw a need for a shift in behavior. And we'll talk about that in a minute.
Yeah.
But these ecosystems don't always interact with each other. They work in parallels in some sense. So yeah, my answer would be yes. Even experts in certain topics, say if you're an expert in blended finance, or you're an expert in results-based finance, or you're an expert in venture capital, or you're an expert in sort of, I guess, microfinance and sort of financial services or fintech, I think you might be interested in other sections of the book, right? Mm-hmm. Which may be not your domain. And so my target audience for the book is the young professional, is sort of somebody who aspires to work in the space and wants to make a difference in the world using capital as a tool for good. But I also think it's equally relevant for Dahlberg staff, for example, and for staff of many organizations that we work with who may be wanting to get that, almost like a 101 plus a 102 on specific topics. And I structure each section in 3 chapters. There's sort of an intro theoretical chapter, which explains the concepts. There's a chapter where I share a lot of my own experiences and personal insights on what's working. And then there's a 3rd chapter where I interview an expert. So somebody who's world-renowned on the topic. And so I think that gives the perspectives that I think, even the experienced finance professionals working in impact finance will find interesting, and hopefully will be nodding their heads.
Cool, indeed. And tell me, in the process of writing this book, what surprised you, the good or the bad?
What surprised me? Well, first of all, that I was able to create a cohesive story, putting all the things together, right? Another thing that surprised me is the amount of love and support that I had through the entire process, right? So, getting folks to be interviewed, the 6 experts that I interviewed, pretty immediate reactions to my requests, saying with enthusiasm and excitement to support. Anytime I asked for questions of anyone I had ever worked with about, is it okay to share this? Or, what do you think about this? People responded with support and enthusiasm. I also found it's quite surprising that even though there's a bunch of books on impact investing, there's not really many books that focus on sort of impact investing in emerging markets and take the breadth that this book takes. And so I think it's sort of one of a kind in its emerging market focus, and also in the breadth of topics that I cover. Talking about things like blended finance, results-based finance, that I haven't seen in other books. I've seen a lot on sort of venture and impact investing and alternative investment tools, but I haven't seen something with this breadth. In terms of a specific insight, it all comes from me, so maybe it wasn't that surprising. Maybe I'll say the last surprise was that I could actually finish, right? Like, I had a full-time job.
To finish, yeah.
I had a full-time job going simultaneously, right? This was a passion project, a hobby, right? I did it on, Friday evenings and Sunday mornings. And, I would say it was surprising, not only finishing, but also how easy it was, right? It sort of just, once I had the concepts of what I wanted to do, it just flowed out, right? It was just putting things together.
Okay, excellent. And to the audience, as we go through the conversation, I do want to take your questions. So please use the chat to put in any questions you may have for Kusi. We'll come back to them. We'll share a link to the book, and Kusi will tell you where you can also get the book. But Kusi, so we know, for example, if you look especially at Africa, aid to Africa is reducing. Our governments don't have the kind of money we need to drive social development. So that model of dependence on aid is under huge threat.
Yes.
I think we've seen in Trump's era, aid was cut. The UK government has cut aid twice now. And even when the aid is coming to Africa, it's coming seeking impact, not traditional philanthropic opportunities. So we've got to look at the private sector, private capital markets for money, if we've got to close some of these gaps in essence. And this is, I think, a lot of the chapters in the book speak to that. But when you talk to private sector players, and from where you sit, your vantage point, do you think profit and purpose are mutually exclusive? Can we do well as we do good? Is that a myth? Is there a role for, do do you strongly believe there's a role for private capital in sustainable development? And,
Yeah.
and as you go through these things, any African examples that you can share with us through your experience?
Yeah, great question. So I'm actually going to unpack it because there's two pieces you had there. One was sort of the setup around, aid is not enough, government finance is not enough. We're going to need private and capital and philanthropy to come in, and which I agree with. So wholeheartedly, right? The numbers, assuming that they don't lie, show that government support is going to be insufficient, right? Donor funds, whether it's directly from national governments or via donors, it's not going to close gaps. So we're going to have to crowd in private capital and philanthropic capital. So yeah, I'm a firm believer in that and the need for it. And I guess to your question of does impact and return. Actually, sorry, one more thing on that. I would just say, like, even before we knew the numbers, based on my own lived experience in Africa, I can tell you that the traditional model for development aid is also dead and should die, right? In my opinion, right? There's always going to be a need for some sort of traditional aid, maybe for emergencies, right? Food crises or refugee crises. But I think unfortunately, the model of dependency almost is not one that resonates with me. A model where people lift themselves up and have the opportunity to create their own dignity is a much better model, whether it's Africa or anywhere, right? The same is true in the United States. And so I don't like the approach where we create an aid-based culture where you make money on one side, you give it away on the other, and that's just the way things work. I sort of challenge that notion also. So yes, aid is also going down, but maybe we can flip and see it as a glass half full, as an opportunity to do things differently, right? In terms of your question around, do they have to be mutually exclusive, profit and purpose? My answer is going to be nuanced. I would say no, they do not, but sometimes they should. And what I mean by that is there's definitely examples, and I have some in the book, and I have some from my own lived experience, where it is 100% possible to find an investment that creates a disproportionate outsized impact, but at the same time provides a nice financial return. I guess one example that I know well is relevant on the African continent is there's a off-grid solar company called Green Light Planet that Global Partnerships invested in the early days to expand in East Africa. And it's done phenomenally well. They just raised Series B investment, have expanded, I think have sold more than 440 million picowatt and other sort of solar products on the continent. And that's, they're doing well as a business, but also they provide access to, small scale lighting solutions for, I would say, dare I say, millions of families, right? So that for me is an example where profit and purpose can work together. That being said, I do think there's an inherent call in my book for sometimes questioning the notion, and this is mostly in Paradigm Shift 3, which I'm saying be an impact first investor, not an ESG investor. I do think you have to question the notion of when do you seek financial return first and above impact, and when do you seek impact above financial return. There are situations when you have both, and you have to ask, am I going to spend the marginal dollar to maximize the impact, or am I going to spend the marginal dollar to sort of jigger up the returns, right? And I think there I'm calling for the world, investors, society, everyone to value the other things beyond financial return as much as they value the dollars or euros or shillings that they get in their pocket, right? And the things that are less quantifiable, things like, opportunity, dignity, and a beautiful natural environment where we can all see, nature thriving, et cetera. So to value those things as much as we value, no, not as much, value them even more in some cases, right? Than we value financial return. So I think my answer is nuanced. I would say, yes, it's possible. It doesn't mean it's optimal.
Yeah, and I think a couple of global crises we've been through, Black Lives Matter, COVID, have taught us the need to really also drive home the impact first notion.
Right, 100%. Yeah, we need much more impact first finance out there. And that's where, I'm excited to be on this call because, venture philanthropy is impact first, right? I don't know if all the organizations and your members are all sort of taking that approach, but venture philanthropy at its core is exactly what that is, right? It's putting impact as the primary objective, still seeking some sort of commercial logic, but really prioritizing impact.
Okay, so I'm going to put you on the spot before we go into discussing the different chapters of your book and ask you, when you look at Africa's development history and our needs going forward, I mean, we've got the youngest population. We're falling further and further behind. We're not pulling enough people out of poverty. Aid is reducing, but we've got vibrant energy on the continent, so on and so forth. Do you think mainstream finance and investment, packaged differently, in the form of impact investing, or whether we look at blended finance or whatever, could be the solutions to Africa's long-term sustainable financing challenges?
Ooh, it's a part. So, okay, I'm going to nuance my answer here. I think systems problems require systems solutions. What do I mean by that? Things like systemic poverty and inequality created by history of inequity, that have impacted peoples and climate in a way that's not fair, is not going to be solved by single tools, right? It's going to be solved by system solutions, things that are holistic and consider many factors. So blended finance, impact investing, innovative finance are all going to be part of the solution and need to scale up. And that's what I'm arguing for in my book. But I don't think on their own will solve all of the problems that will allow Africa Rising to achieve its potential. And as you speak of Africa Rising, it's funny because I was just looking this morning. It's morning still here. The latest issue of National Geographic was talking about population trends, and everyone knows it. But Nigeria is going to triple in size by 2050 potentially, right? Like it's going to be the third largest country in the world, right? If current trends continue, right? Like that's an unbelievable opportunity, right? If you think about it the right way, and capital that takes an impact first approach that tries to help people lift themselves up is going to play a huge role in making sure that Nigeria and other countries in Africa realize those opportunities.
Okay, awesome. So let's unpack the book in a couple of the sections that you put. I mean, first of all, I really liked how you laid out the book. I think it was in a format and manner that I totally buy into and believe. And that's one reason why I was quite keen to talk to you. So in part of the book, you talk about, you title it, Provide Patient Capital, Not Venture Capital. Do you want to talk some more about this point? And especially when you think about in Africa, where we're told that there's more capital than the investable pipeline, why do we see when you talk about patient capital, and for people on the call who don't understand what patient capital is, how would it make a difference? And especially when you compare it to venture capital?
Yeah, great question. So as you mentioned, I organized the book in the 6 paradigm shifts. Basically, I'm calling to task, I would say, sort of specific actors who are already in the ecosystem acting to do more, to be more impactful. And in this paradigm shift number 2, which as you said, is provide patient capital, not venture capital, is really targeting those who are supporting early stage businesses primarily. Not just early stage, but small businesses, growing businesses, but mostly early stage businesses. And through work I've done I saw Sally on the line with organizations like Small Foundations and the Collaborative for Frontier Finance. We learned that small businesses are not all one alike. In fact, the majority are quite diverse. And we created this segmentation you'll see in the book that has 4 different families. That we have the classic high growth ventures, the hockey stick growth companies that everyone's looking for, that are right now primarily tech companies, software companies that have the potential to scale in terms of addressable market, have the potential to really seize the opportunity out in front of them. But those are really 1 in 1,000 opportunities. The vast majority of businesses are not hockey stick high growth ventures, right? There's all these other families of businesses, and I call them dynamic ventures, which are more steady state, medium-sized businesses or small businesses that are going to grow, at a steady rate. They may have some volatility, but they create jobs and opportunity through things like agricultural cooperatives, restaurants, automobile shops, and other sort of stable businesses that exist throughout, the world, and especially in places like Africa. And these companies, typically with financing needs between $20,000 and say $2 million, are vastly underserved. In fact, they're mostly ignored, right? They have to figure things out on their own. Some banks do SME lending, but their SME lending programs are quite insignificant. And some, I guess, impact investors and others will go down market a bit and consider investing in these, but they just don't have the ability to do the thousands of investments required to serve them. And so there's this missing middle. And there's other two, I won't even go into detail, but there's one I call niche ventures, which are, impact driven in some sense, businesses that are prioritizing impact over financial performance. They're more creative in the business models they create, but they don't prioritize growth, and therefore they're also harder to finance. And then the last I call sort of livelihood sustaining businesses or enterprises, and these are smaller businesses that are just barely surviving but growing above inflation. So anyway, all of those three other families are not well served by venture capital, right? The venture capital model uses the power law, which basically says we're going to find those 1 in 1,000 or 2 in 1,000 businesses, and all of our financial based on those. I think that model doesn't work for the majority. It doesn't work specifically for low and middle income countries. It's not designed. It's like exporting a solution that works in one context to another. And it does work for some businesses, but it doesn't work for the biggest problems we're facing. So therefore, I think we need to think about patient capital models is what I'm summarizing as an approach to investing in small and growing businesses and early stage ventures that considers the needs of the enterprise first, designs financing based on what makes sense for them and not based on what makes sense for the person who's providing capital, right? And part of that is, as patience itself says, is being patient. So if you're an equity investor, it's not having the time horizon of that classic 5 to 7 years. It's about exiting when it makes sense to exit, and make sure you're handing off that exit to the next investor or acquisition or scale that enhances impact, right? That really allows that business to thrive, right? Instead of trying to reach your metric, right? So, in practice, what does that mean? I think things like cacao plantations, things like biotech ventures, those require time horizons that are well beyond 10 years. And so we need to sort of, extend the expectation horizon for returns. That's part of what patient means. But it also means we need to design better the financing itself. Right? So it's not simple dilutive equity products, but also non-dilutive instruments, equity that has debt-like features, or debt that has equity-like features, right? And I'm sure on these calls you've had discussions around some of these, alternative finance, and there are some books on this. And Ani Power's Venture Finance is a great one. It goes into detail. I do mention some of those instruments in the book and explain how they can be used. But I think it's also as much about really responding to the needs in terms of tailoring products, being patient, and taking I guess an impact first mindset in terms of how you're making your investments.
Yeah, I totally agree. And I think, Kusi, I think we've seen so many people say that in Africa we have more investable pipeline than we have more capital than we have investable pipeline. But the reality that there's some truth to that. But the reality is also investors don't package capital in a manner that meets our African entrepreneurs.
100%. Yeah, 100%.
Yeah, and that is a problem, and that's a problem we need to address. And we are actually having a conversation about doing an institutions program at AVPA where we build. We're trying to build capacity in African universities to teach impact and sustainable finance to investors, so they can get better at not doing investor fast financing, but enterprise fast financing, and a lot more demonstrate a bit more empathy in how they package capital for enterprises, and we move beyond the traditional just debt and equity. There's so many other instruments we can use. A woman who doesn't have collateral to borrow money can't access capital because she can't own land and so on and so forth. But there are other instruments we can use to test her credit worthiness and give her access to credit and money. So those are the kind of things I think we need to explore and unpack a bit more.
100%. I'll just add something. Yesterday, I had a conversation with somebody and they were asking me, so what if, say, the central bank of Kenya or Ghana or, Senegal is pushing out capital into the market with certain return expectations. And so if you're a capital provider and you're getting money from the central bank to push onwards to your enterprises, you're constrained based on the expectation returns of your own central bank, the regulations. It's true. That is a problem.
Yeah.
Right. So it's not just the capital providers that are creating the problem here and not designing solutions for that are enterprise led, as you said. It's a systemic issue as well, right? We also need to work with the sources of capital to make them understand and value, and the central bank's sources of capital as well, right? So it is working with institutions to maybe there's having different tranches of capital with different needs. I do see an increasing number of pension funds interested in investing in impact investment vehicles on the continent, and that I think is a really exciting development. It's suggesting that they're starting to see the opportunity and also to change their own mindset about their sort of risk rewards of what the sector looks like.
Yeah. What they asked on the chat, whether you think there's some sectors, challenges, or just issues that are better positioned to attract or utilize special. What's your experience?
Yeah. So my own experience, I did mention too. One is healthcare. I do quite a bit of work in the healthcare space. We manage a community of practice called Investors for Health, which is sort of 26 emerging market healthcare investors. And I can tell you, there's not a lot of healthcare deals in a place on the continent that have short-term returns, right? Unless you're talking, even things that are more commercially oriented, like hospital infrastructure, it's going to take at least 7 years to see any sort of real positive cash flow back into those investments or ventures, if we're being honest with ourselves, right? Like the return on investment to turn positive. And then if you're talking about things like are even harder, which is pushing out primary and specialty care clinics and services into rural communities, to reach a scale at which that can actually become financially viable, takes time. And takes a lot of patience and probably some subsidy to make it work. And so healthcare is one that jumps out. I also think agriculture is another one where, not talking about the service providers or the tech solutions, but I'm talking about the primary production. If you're going to do it the right way, you're going to do active agriculture practices, for example. You're going to convert land into land that's sustainable, and then you're going to see mixed crops, some tree crops, perhaps mixed with, other types of crops that are more seasonal. It's going to take a while for some of those investments to reach the return and scale that makes those type of opportunities, profitable. So the example I use in cacao is if you were going to start a cacao plantation from scratch, a new cacao seedling, it takes, I think, 3 to 5 years before it even starts producing cacao, but it doesn't really hit its prime until sort of 7-8 years. And then from there, you got to get, you're rolling it out. It takes time to get the investment up. And so really you're seeing 10 years plus until the model starts to hum. That's assuming you're starting from scratch.
Yeah.
But yeah, there's lots of opportunity areas.
Yeah.
Go ahead.
And some education models and opportunities as well would need patient capital.
Yeah.
The each of the duration and how they take.
Cool.
So in part 3 of the book, you talk about what I find a very fascinating thing. You talk about being an impact investor, not an ESG investor. Before I go any further, and this is very important because many people are not sure about the definition and difference between those two. Please unpack that for us. What's the difference between impact investing and ESG?
Yeah, great. One of the big questions. So there's been a bunch of discussion on this. In its simplest form, I'll start with the 2 biggest differences. Number one, impact investing is has intention in it, and ESG doesn't have intention. What I mean by that is impact investing is a strategy in which you intend to see a positive contribution or change in the world, whereas ESG is sort of a way of accounting for whether or not you have carbon emissions, whether or not your labor is protected, whether or not you have women on your board, et cetera. You know, a whole host of metrics. It's not an intention play. It's more of an accounting play. So one is more of a strategy that has an intention in it. The ESG is more of an approach to investing that accounts for the potential negative, you know, positive and negative externalities you have that are related to the environment, social, and governance, right? The second, and which is really important, is that impact investing as a strategy goes a step further and says it's important to measure those intentions and whether or not those intentions are actually being fulfilled, right? So ESG funds still are being primarily judged based on their financial performance, whereas impact investments are reporting on a whole host of types of impacts. You know, I think we do need to standardize a bit more our impact reporting, if I'm honest. But I do think, you know, there's the intention and then there's the measurement and follow through to report on your performance against those metrics. In addition, so one is a strategy, one is more of an approach. You know, impact investing is not a sector, it's not an industry, it's a strategy. Right, let's be clear on that. In addition, until now, impact investing has been primarily private market. What I mean by that is it's investments that are not accessible to the public. You know, they're, you know, managed investments, direct investments primarily. Now that's changing a little bit. There are some now public market impact investing products. I'm not sure if I look at them closely if I agree that they're really impact, but they exist. They're branding that way. Things like Innova, based in Switzerland, which is a sort of a public investing platform that says it does impact investing, but it's a minority. Whereas ESG is a primarily public market strategy. So we have a bunch of, you know, investment vehicles and opportunities that you can invest in most markets that are, you know, branded as ESG products. Now, there's been a huge backlash on those products, wondering whether or not they're really ESG and whether the indexes that they're based upon are actually measuring the right things. And I think that criticism is justified, to be honest. If I know I took an early look myself at things like the MSCI ESG index, and I saw basically tobacco and oil companies in the top 10. And I said, that doesn't align with my values. Yeah. This may be an ESG, and sure, they're probably doing good practices, but inherently there's something wrong with this business in the world, right? It's reason for being in the world is not to contribute solutions. Its reason for being in the world is to make money pushing products that are probably unhealthy and unsustainable for the planet and people. And even if it's got women on its board and it's got great labor practices, provides great benefits, and is figuring out ways to cut its carbon emissions, I'm not sure if that gets over the hump for me. It's great that they're reforming, but it doesn't pass the muster. So that's really the difference between the two. But in the book, I go into much more detail, like what would it mean to actually be an impact first investor? And here I've considered myself quite fortunate. Not only have I worked an impact first investor on the private market side, but I now have advised several asset managers that I would consider are deploying impact first strategies, from folks like Acumen Fund, you know, all the way up to 2 or 3 of the world's largest asset managers who are actually creating dedicated impact products and funds. And some of those funds are, you know, $1 billion plus funds, and they're professionalizing the approach. You know, they're not taking it lightly. They're applying the same rigor they do to all of their other products and what they're putting out in the market. And guess what? Those products, and to a large extent, are getting oversubscribed. You're seeing more and more large private equity firms are offering impact funds and products. Because, you know, guess what? Not only are they seeing the groundswell of enthusiasm from consumers to the desire for those products, but you're also seeing the sources of capital, the pension funds, the sovereign funds, asking for or asking questions. Whether or not they're dipping their toe in yet is debatable. Some of them are, but they're asking tougher questions. And, you know, I think it's pushing the tide a little bit towards, or it was until recently. We've got a little bit of a backlash going on, but there was a push in the tide towards getting more of these large scale funds to provide impact products. I'll bring this to life with one more example. Last year, I was at SOCAP. Some of you may attend that conference in San Francisco. I've been going for 8 years. Was sort of disappeared during COVID, but came back and was in a new venue. And the participants last year were remarkably more in the commercial investing scene than I'd ever seen before. It was Goldman Sachs, Morgan Stanley, BlackRock, Blackstone. They were all there. Now that, I remember in previous conferences, you had Bain Capital, maybe TPG, but not this like mainstream capital. So I think it's exciting. There's an opportunity brewing. I think we're seeing that trickle out. I see a lot of impact first private equity funds on the continent, not a lot, but there are some. And I'm excited to see that trend continue.
Yeah. So, yeah, it's very interesting because we look at ESG is very, very well adopted on the continent of Africa. And I look at ESG as doing no harm.
Yeah,
it's not so much about adding to society, it's about doing no harm. It's about protecting the organization from risk. And I think we've got to move beyond ESG. This continent needs private players and corporates and organizations and private capital doing more than what ESG is promising to deliver. And we, funny enough, actually have just partnered with UNDP to roll out an SDG impact standards program for corporates. That one of the things that it does is to how do you help organizations move beyond ESG, move from impact, not just impact measurement, to impact management, and how do you embed impact into your strategies and operations. So it was interesting just to see your comment on that. But your fourth part was even more fascinating for me when you talk about offer catalytic capital, not just blended finance. That's very interesting. So before you go into explaining what you meant there, please explain to our audience what catalytic capital is. And then please go in and talk about, why does that statement carry so much weight in your book? And I'm quite keen to hear your point of view.
Thank you. Yeah. So this is probably the paradigm shift that maybe rightfully will get one of the most attention. The paradigm shift 2, 3, and 4 are really the ones, but 4 is where I take aim at the public finance institutions that are providing development finance, development DFIs, right? And many DFIs have something called blended finance, which is the use of government or philanthropic resources to crowd in third-party capital, right? Using things like first loss, guarantees, technical assistance, or concessionary subordinated debt. And unfortunately, well, that's blended finance. The other side is catalytic capital. Catalytic capital is really about using philanthropic resources, also government or donor funding, with the same objectives, but more than crowding in third-party capital. It's about creating demonstration effects, building new markets, bringing to life solutions and innovations that are needed in the world that aren't working, right? Or aren't working yet. It's almost like industrialization for enterprise, right? And I think blended finance by DFIs is being used in a more risk-averse manner than it needs to be, or should be, I should say. More blended finance needs to be intentionally catalytic. Needs to ask the question, not only am I crowding in a large investor or another investor, it's what are we doing collectively that moves the needle forward? Are we creating a new market, right? Yeah. Are we expanding off-grid solutions to a country that never had? Are we proving the model for regenerative agriculture? Are we bringing a needed vaccine solution to a population that doesn't have access? So really, I'm calling for development finance institutions to be more intentionally catalytic, take greater risk. I do mean take greater risk. I mean potentially losing more money as a consequence of taking some of these risks. Yes, because ultimately I think that is the role of a development finance institution. The government resources and the blended finance resources in specific are philanthropic, they're donor government funding, right? They're funding that's being provided without the intention to be returned. The DFIs then turn around and use it in a way that's trying to preserve that capital, right? Their incentives are to preserve that capital and maintain their AAA credit rating, instead of whether or not that capital is being used to really push the boundaries of where markets can work. And so I think blended finance needs to scale, but specifically catalytic blended finance needs to scale. Unfortunately, it's still less than, I was just recently doing a sort of updated research. I think I looked across sort of a dozen or so DFIs, and it's less than 10% of their investment portfolio per year. Does that really make sense? And to me, everything a DFI does should be blended finance, right? Maybe not everything, but it should be a much bigger share of their operations than it currently is.
Yeah.
And then I think we need to put them to task to make sure they're being catalytic with the use of that blended finance.
Yeah, because what you're really short of, Hussein, let me know if you agree with me, what you're really short of is risk capital in the world. That's what we really need.
Mm-hmm.
And DFIs were supposed to come and play in this space between aid and private capital. But many of them are seeking as much market returns or returns as private capital does. So it beats the purpose of having them in our markets, to be honest with you. And that really actually irritates me of the gap that DFIs are creating. But in the same breath, if I look at what you're talking about, in essence, about catalytic capital, it speaks to the evolving role. My interpretation is it speaks also to the evolving role of how we use aid philanthropy and to test new markets, new products, new services, to the point where they almost have a proof of concept that then can be scaled up by more commercial capital. But what paradigm shift do you think we need to drive also amongst philanthropists for us to create more catalytic capital and governments as well?
Yeah, so two parts to that answer. One is getting into paradigm shift 5, which is where I take philanthropy and donors to task. But I do think specifically to that question related to blended finance, donors need to ask DFIs that they use their blended finance windows and they're taking more risks, right? With that. It is ultimately the shareholders of these DFIs that will push the agendas. And so you're not seeing the behavior change and the incentives created yet that are enabling the people who work in these institutions to actually take those additional risks as you described. So donors need to push DFIs to be, more truly developmental in their financing than, bankers.
Yes, no, absolutely correct. No, totally agree with you. So please, to the audience, please post your questions in the chat. We're coming to the end of the questions, and I'll be very keen to take on your questions and make sure that Kusi addresses as many of them as possible. So speaking of part 5, where you take on donors and aid agencies, you talk about measure success, not activities. And you talk quite a lot about results-based financing in that chapter. Please unpack that for us, and why do you think this is such an important thing? Is there space, for example, for governments to also adopt results-based financing in things like tenders? I've always wondered, what if all the tenders in Africa would become results-based financing tenders? Would we close corruption? Would we deliver better outcomes from the tenders that governments issue?
Yes. So I'm going to answer that first and say it's 100% possible for governments to be issuing tenders with a results-based mindset. If you look at the history of innovative finance in, say, the UK and the US, you'll see thousands of government procurements using a results-based logic, right? Not dozens, thousands. So it's very mainstream. Essentially, what I'm asking for here in Paradigm Shift 5 is to, similar to blended finance, is like tip the balance of the share of donor funding and philanthropic funding that is going with a results or performance-based structure versus an activity-based structure. What do I mean by those two things? An activity-based structure is the way tenders work today. In the vast majority, say, we have an objective provide financing to smallholder farmers in Ghana. To do that objective, we have 5 activities that we think you need to do. Find a bank to work with the bank, do a training for the program, right, etc. Right, and so the contract then becomes paid for the completion of activities. And there's some monitoring and reporting. There's this pre-assessment. Sometimes if there's extra money, there's a MEL report, which allows for a baseline and then a sort of a post what happened, right? Which is okay. A results-based approach would say, we don't care what you do necessarily with the money. We care what happens as an end result. So we care that the families that receive financing, the smallholder families, see income increase or transition to higher yield crops or some sort of specific objective that they're trying to receive as an outcome of that funding, right? And then the ABC is up to the recipient of the capital to decide how to do it, right? Now, there's many different flavors of how you can incentivize for results. Unfortunately, there's an overemphasis on what people thought of as impact bonds, but there's many different other flavors, which I think are better or more effective, things like impact-linked financing. And I'm calling for a massive scale-up in a mindset shift and also in a way finance is provided that's less conditioned and more focused on outcomes. And it's possible. I'll give you a specific example that I'm excited about right now. Bridges Fund Management is managing something called the Outcomes Fund, which is essentially a results-based fund that will invest in, it's not just in Europe, but also in Africa. They're investing in Africa, I think in Ghana and a few other places, that are existing projects that are looking for an outcome funder to help them sort of get the finance they need to implement and scale their operations. But that's the goal is to be $1 billion in size. I think right now it's about 200 million. So just a drip in the ocean, but there's things out there. And yeah, currently the World Bank is only doing about 3% all of its financing in a performance-based structure. The vast majority are policy-based loans or other types of traditional financing, and I think that 3% needs to go up to at least 20, if not 30%, So I don't get overly prescriptive in exactly how, but I think there's many, many opportunities for specifically philanthropic organizations. And here there's an opportunity for those who are on the line who may not know about innovative finance. I definitely encourage you to pick up this section of the book and learn about I profile 9 different innovative financing instruments and then go deep on impact-linked finance because it's really working to think about using those solutions in your own work.
Yeah, I totally agree. And that's one reason why we are running this Catalytic investment training program, the first of its kind in Africa, conjunction with Arthur, because there's such a huge need for people to understand how catalytic capital and finance can really unlock that early stage pipeline that will build the next level of jobs and medium and big enterprise on the continent. But we need that risk capital at that stage. It's very important. So it's tied to a question that from one of the guests, Michael Karaimu, who talks about angel investors and stuff. When you talk about all what we've covered today, what's in your book, is it only applicable to the big investors? Or can small ticket size investors, angel investors, family offices also be able to apply innovative finance and impact investing and apply these lessons and themes you're trying to bring alive in your book?
It's a great question. Thank you for the question. The answer is that these lessons and these approaches are as relevant for the small as it is for the large. We often talk about the large organizations because there's the opportunity that they can create that ripple effect by changing their behaviors. But I think in my own work experience, I've seen it's the small organizations that are nimble and agile and create some of the innovations and demonstrate how things can work. So there's lots of angel investors. I often think of an angel that I know. I'm not going to mention a name, but he was very catalytic in his investment approach, right? He was, once he got to know an opportunity, he spent a lot of time, just as any angel would, understanding the business, et cetera, et cetera. And then once he was convinced to invest, he provided everything it needed, from, equity, debt, grant support, partnerships, all the things that would be necessary to help the business succeed, and stuck around, right? And provided the connections as the business grew, and didn't have a predefined exit or terms, et cetera, and was really sort of thinking about building the solution in a way that was truly catalytic. So I think, and he was investing tickets, under $100,000. So I definitely think the small guys can also be catalytic.
Experience in emerging markets. Why? We know that there's the gap. We know that this gap is existing. The SDG financing gaps are growing wider and wider by the day. Why are we seeing an increase in the adoption of these innovative financing models, approaches, and structures? What do you think is holding us back?
Yeah, I think there's two things, amongst others, but two things that jump to mind. One is, I think there's knowledge gaps. So there's lack of familiarity in the tools. And then the second, there's like transaction cost challenges, right? Unfortunately, innovative financing to this day seems complex and burdensome, requires multi-parties. And so in terms of structuring the products can be complicated. I mean, a good example are a very cool product in the innovative financing bucket is called debt for nature swaps. Basically, you negotiate between several parties that a country's government debt is reduced if that reduction in debt savings is used for conservation.
Mm-hmm.
But just structuring a contract involves the community, the government, the working capital provider, the NGO that provide the services, et cetera. So the transaction cost of structuring the product is significant, just bringing the people together. And so I think that complexity inhibits activity. And I think that's just part of the learning curve that we're going through to figure out what works and how to make it, reduce those transaction costs and frictions. So that is another great role for philanthropy, is like helping to accelerate the progress so that those transaction costs go down. So I would say it's knowledge and transaction cost challenges right now.
But sometimes the right things are hard. So it's we have to be.
That's right.
Yeah, but tied to your comment about transaction costs, Michelle Akande asks, results-based financing can come with a hefty price tag, sometimes up to 8 to 10% of the outcome funder, in brackets competitive versus market, but still significant if the outcome funder is a government or smaller business. Are there any examples of result-based financing interventions where there are more concessional returns are seen?
You mean where the upside for the working capital provider is sort of concessionary and capped?
Yeah, I think maybe just on the 8 to 10% mentions as a cost to the outcome funder.
Yeah, absolutely. Well, so first of all, you're right. Depending on the size of the overall financing need, the transaction costs can be even above 10%, right? And that's a real problem, right? That needs to come down, and that is, until we figure out a way to bring that cost down through standardized templates, tools, experiences, repeat experiences, then it's going to continue to be a challenge to scale. In terms of getting the risk capital provider to accept concessionary returns, I would say yes, I have seen that. I've been involved in 2 impact bonds, one in cataracts, eye surgeries, and one related to girls' education. In both cases, the risk capital provider took a return on capital that was below, their alternative investment opportunities, their best alternative investment opportunities. It was still what I would say aggressive returns, but sub-market.
Yeah.
So I think it's a negotiation is what I've seen. But I do think that's a negotiation worth having. And I wouldn't just assume that the risk capital provider automatically gets to have the full return. I think sometimes they're willing to participate in the transaction because they have other benefits. There's the PR benefits, there's the benefits that they also want to generate impact by participating in the transaction. So it's not a simple just assume that they should be maximizing their returns and the outcome funder should be paying for it. I think there's a very plausible reason to have a conversation around how do we share the benefits and the risks.
Okay, so Ray Baruch asks, talks about, if you look at, ask what are your views on impact debt funds as opposed to equity impact funds? What are the key development areas you expect in that space in the next 10 years?
Yeah, it's a topic near and dear to my heart. So I used to work at an impact debt fund. What made, venture debt, some people would say. One thing that I observed is there's a far shorter supply of venture debt or impact debt than there is of impact equity, it seemed like, because almost every business needs working capital or some sort of debt financing. There's very few that can completely self-finance, right? So debt is needed, right? But there is, not every business needs equity.
Mm-hmm.
So my answer is we need to see a lot more venture debt. We need to see a lot more impact first debt. We need to see a scale up in those products and providers of that type of capital, and specifically targeting missing middle businesses, right? In that $20,000 to $2 million in financing needs, to a far greater size and scale than we have today. So I think it's going to play a critical role in serving missing middle enterprises, and I'm excited to see more of those type of funds. And not just funds. Let's be honest. Like, funds isn't the only solution. Investment vehicles, exist in these ecosystems.
Yeah. So Kusi, in closing, what's your call to action for your readers? And do you have a plan of how you want to engage with your readers, get feedback, so on and so forth? And then where can they find the book?
Yeah. Okay. I guess my call to action would be, if you work in philanthropy, impact finance, development finance, and you want to scale impact, I would say read the sections of the book that are relevant to you and ask hard questions about, are we doing enough to take risk, to prioritize impact, to scale solutions that are working? And maybe the answer is yes, but maybe not, right? And if so, and if you think it can be helpful, I'm happy to respond to any of those questions as you think those through in your organizations. I encourage you to read the book and evangelize and send it out into your communities. I think if you believe in the messages, you can help me to get the word out and get others to believe in them too, specifically on the continent. And I think what's different about my book maybe than others as well is that I think it is accessible and relevant to sub-Saharan Africa and other emerging markets, right? I'm targeting specifically the continent as a potential reader base because I want to see innovation and solutions scale faster. This is where it's most needed. So I definitely encourage you to check out the book. It's online. You can buy it on Amazon, or you can buy it through the Palgrave Macmillan website. By the way, if you buy it on Palgrave Macmillan, it ships free everywhere in the world. And if you do reach out to me, I can get a discount code for the hardcover. So, I'm happy to, my email is on the website. The website, I think, was shared in the chat, but it's, www.scalingimpact.co. There it is. Yeah, so I check it out and spread the word. And just thanks so much, Frank, and everyone for listening. It's really been an honor.
No, Kusi, thank you so much. And if people want to contact you, so email is the easiest way. Do you have places where online where people can send you comments or?
Yeah, if you do buy it on Amazon, I would love a review. That really helps me boost sales. So providing reviews on Amazon or any other place you buy it, is helpful. You can contact me and add me on LinkedIn. I'm an active LinkedIn user, so I will probably see your message and respond. So. And then you can.
I can vouch for that. I can vouch for the fact that I did reach out to you and you came back to me. So thank you for that.
Absolutely. And then yeah, the email address is on the website. I think it's Kusi@scalingimpact.co. So.
Okay, fantastic. So Kusi, really great to have had you with us. I really appreciate you sharing this with us. And as you go around launching the book, getting more experience, we'll definitely welcome you back in a couple of years just to get a sense, how's the journey been, and
Sounds
what,
good. Yeah, we'll do.
yeah, what has it shaped in terms of your thinking. And hopefully there's another book coming up 2-3 years from now, and we'll look forward to that.
Called
In the
Scaled
meantime,
Impact. We'll talk about success.
exactly. In the meantime, yeah, before you all go, Abu, over to you to wrap up the session. But to everyone who made time to join us today, thank you so much. Really appreciate the time. This recording webinar will be made available. You'll get a link sometime in the next couple of days. So Abu, over to you.
Thank you very much, Frank. And thank you very much, Kusi, for an insightful session. I'm looking forward as well to reading your book and your upcoming book as well after you scale the impact. To close off, I'd once again like to direct you to 2 activities that we're currently running that we need your input from. So the first one is the Catalytic Capital in Africa survey. So if you could take 5 minutes to help us understand the state of catalytic capital, please do. That'll be very helpful in our planning for the upcoming Catalytic Capital Planning Program that'll be running later in the year. My colleague Abby will post a link to the survey in the chat. The other one is we have until the 31st of this month to nominate impact investing practitioners driving positive change in Africa. So if you yourself or you feel someone else in your network is doing some awesome work in impact investments, please do nominate them, submit their names and details for nomination so they can be in the running for the awards that will be announced later this year. Thank you very much. And I'll hand it over back to you, Frank, to officially close it.
Yeah, thank you, Abu. If you can just go to the slide with the programs. Once again, someone asked how they can get connected to, yes. So if any of you are interested in any of these programs, there is an email address. Please do get in touch with us, send Abu an email or info@avpa.africa, or follow us on LinkedIn and be able to connect with us. But thank you everyone for making time. Please do look out for our next webinar that will be on the 11th on Catalytic Capital. Abu, if you go to the next slide, that is part of a build up to the Catalytic Capital series. And we look forward to having you. Invite your friends and family to join us. We're always trying to make sure that the conversations at AVPA are topical and relevant to the continent. And remember, we're launching AVPA shortly in Cape Town. If you're interested, please connect with us. And of course, there's the Africa Impact Summit that's coming up as well. People who are working with or in family offices, please connect with us. We're trying to see if we can pull together a Pan-African family offices gathering with a view of catalyzing a community of practice of African family offices. Otherwise, thank you everyone for your time. Most appreciated. Have a nice week ahead and stay blessed.